Good afternoon, ladies and gentlemen. Thank you very much for joining us here this afternoon as we talk about building a robust financial sector for a competitive economy. We will, of course, get into the nitty-gritties of what it is going to take for us to be able to do that. But just to set the context of where we find ourselves today in 2023, I think the prognosis is looking good. Everybody that you speak to at this point in time, not just within government but outside of government, also does believe that India is poised to be in a sweet spot. There is a lot going for us at this point in time, whether it is on account of the diversification of supply chains, or it is the fact that we have ensured that there is macroeconomic stability here, whereas the West is facing headwinds on that front. We've also seen a cooling off as far as inflation is concerned, resulting in the Reserve Bank pausing at this point in time. The Governor, of course, making it clear that this is a pause and not a pivot, but the hope and the expectation is that perhaps we've peaked as far as interest rates are concerned. When do we actually see the cycle turn is the question, but the expectation is perhaps towards October or past that. So without further ado, we do have with us a great set of speakers who will outline for us what they believe the course of the economy looks like, and more importantly, what they believe the execution roadmap in terms of measures that we need to put in place, in addition to the steps that have already been taken to ensure that we remain competitive and that we do have a stable financial sector. Let me introduce our panelists here to you. I'll start by introducing the Chief Economic Advisor. Don't really need to introduce him, but Mr. Nageswaran, many thanks for joining us here today. Also with us, Puri, the Chairman of South and Southeast Asia at JP Morgan Chase. Mr. Puri, appreciate your time. Mr. S. Ramann, the Chairman of the Small Industries Development Bank of India, or SIDBI. Mr. Ramann, it's good to have you. And Kaku, Nakhate, the President and Country Head, India, Bank of America. I want to pick up on the point that you made about be careful in the good times and don't repeat the mistakes of the past, and hopefully you believe the indigestion that we saw has found its way out of the system, and that's very evident whether you look at balance sheets of corporations or you look at balance sheets of banks. The deleveraging has taken place, the cleanup has taken place. You talked about the risks of overheating, but are we perhaps faced with a different kind of risk today, where we are seeing, in your words, incipient signs of private capital picking up, but perhaps not to the extent that the government would hope for, which is why the government keeps sending out the message to the private sector, go out there and spend. Is it a risk-off, risk aversion, or at this point in time, because of the uncertainty that we are faced with globally and perhaps not enough demand visibility domestically, the private sector is still holding back?
Shereen, you're absolutely right that right now it is not the time to worry about overheating risks, and that comes much later. In fact, I would be very happy if it comes even later than it came in the previous cycles. And also, as for risk aversion and caution, to a large extent it is understandable given the kind of developments we have faced in the world and also in India. Barely had we finished repairing balance sheets, we had 2 years of pandemic, and then the war, its impact on commodities, and then sustained interest rate increases globally elsewhere. So to some extent the caution is understandable because there is less visibility on demand going forward. But that said, we do see signs of the corporate sector beginning to invest. You have seen that in the data on new project announcements, and we have seen that in the data on based on bottom-up cash flow statements of companies, that in the last 3 years, based on data available for the first 6 months of the financial year, in 2021 it was around 2.1 lakh crores, investments made by about a few thousands of private companies, and 21-22 it was 2.7 lakh crores, and 22-23 it was 3.3 lakh crores. So it's been rising, and once we get the full year data, we will get the picture. And we know that the internal resource generation of companies is absolutely at a very high level, and therefore they may not necessarily have to tap either the capital market or the banking sector because they do have enough profitability to fall back on first. So I think I'm constructive and optimistic about the private sector capital formation cycle in this country. We have been waiting for it. It's already unfolding, and it's perhaps just as well that it unfolds gradually rather than too furiously.
But how gradual do you expect for this to pan out? Because as you pointed out, we've been waiting for a while now.
As I said, the numbers show that it is happening. It is happening, and capacity utilization in some sectors like steel and cement have reached a point where greenfield investments have to happen. And I think it is not just something that we are waiting for. I'm saying that it is unfolding, but unfolding at a steady pace, which is good enough for us.
Before I get the other panelists in, let me ask you a question in terms of competitiveness, and I'll put this in the context of the fact that we've now seen the Reserve Bank pause. Globally, we don't know what is going to happen as far as the US debt ceiling is concerned, whether they will arrive at a decision before the 1st of June or not. And the commentary from the Fed overnight seems to suggest that there is a split on whether we are pausing there as far as interest rate hikes are concerned, or the Fed will continue to hike rates. Do you believe that we are in a long pause, or do you believe that it is now perhaps possible that we could see a change in the cycle by way of rate cuts coming in even earlier than October, which is the expectation at this point in time?
Talking about India or the US?
India. The US is still considering hiking.
No, I have always said in my last 16 months on this job that I don't comment on monetary policy in public. So I'm not going to change that stance.
Okay, you want to take a stab at what you think the Fed is likely to do?
No, I think they have given the indication that they would be on pause in June. And I also don't believe that in the US case, I think rate cuts are imminent. I don't think so. Unless, of course, there are further financial accidents like the ones we saw in the last 2 months in March and April, etc. Because if you look at the macro data, they are still holding up very well. So I think stable for longer might be more likely than looser policy, but that's my personal view. Yeah.
Well, we will find out soon enough. Leo Puri, let me address the issue with you in terms of where you believe we find ourselves poised at this point in time, given the fact that there are significant global uncertainties and macroeconomic headwinds. And more importantly, from a competitiveness point of view, in order of priority, what next is the expectation?
Thank you. And I mean, first, the good news, I mean, to pick up on Anand's points, actually, we do have a much healthier financial system than we had 5 or 7 years ago. I mean, the measure of success of a financial system is one that allocates capital efficiently at relatively low intermediation cost while bringing about financial deepening or inclusion. So it's not a very, in that sense, complex task. It's actually quite straightforward, and we should always keep our eyes focused on this. In terms of capital allocation, I think we really hit another some years ago. I don't think it could have possibly got any worse. And where we are today is that as a system, we are allocating capital more efficiently, which is why, as Anand said, you are seeing much healthier balance sheets. It's not just the cyclical effect of high provisioning and coming on a bounce of that. I actually do believe we are better at allocating capital today as a system than we were some years ago, whatever the reasons. Intermediation costs are also down, which is also evidenced in all the numbers that you see, which means we're a more efficient system. Some of this is due to government intervention around consolidation of private sector, public sector banks, streamlining. The private banks, of course, have pushed technology, as have the government banks. And so productivity levels are also much higher, which is very important because it lowers the cost of access for all of us, whether we are businesses or consumers. And that's a great sign of health. Financial deepening is indeed one of India's success stories. And I think it's been recognized all over the world that what we did with, JAM and so on was really something that has followed through. And it's truly been a success story. So to your question, given that all this is good news, what remains to be concerned about? I think the first is that we are still a very bank-dominated system, and capital markets more broadly, which is ultimately the true engine for growth for a developing economy such as ours, remain somewhat anemic relative to our aspirations. We don't have unhealthy capital markets, we just have subscale capital markets, in my view. And I think we have to keep revisiting this issue because we can't really expect ourselves to grow given our sensitivity to dependence on foreign flows. So we could do what Indonesia, Thailand and other countries did and just open up the taps to foreign flows. for various reasons, our mindset and our political establishment and the RBI and so on is, in my view, highly unlikely to do that. That would be an easy option. So we're not going to get to 30% of our government bonds being held by foreigners or any of those solutions, which would be an easy way to bring in capital. So you really are talking about the development of our own markets, bringing back some of the business which is done offshore, which is where Gift City and other things come on stream. And that's a central issue. The second area of concern is that at this point, we are still we are a well-regulated system, which is a good thing. I think, again, the time has come to debate whether we are possibly a little over-regulated in some dimensions of the development of the system. So, again, we have an opportunity to, I think, revisit that.
Kaku, let's address the issue on what you believe are the points of concern and what you believe needs to be done at this point in time. You know, the two of you were at Gift City, and the hope and the expectation is that perhaps we are at some sort of an inflection point with Gift City picking up, that we will start to see this market develop in a much more robust way. You know, your thoughts?
I kind of agree with Leo very clearly that capital markets have to grow in India. Gift City is a big starting because at least we now have our own international financial center. We now have banks there. We have asset management companies. And of course GDCs, and the ecosystem is building. And rather than, you know, rerouting things from Singapore and Dubai, actually getting in capital through Gift City clearly makes sense. The SGX, IFSC, you know, Nifty index also will be a big starting, and commodities would also be. But the big point is that we do need to create an ecosystem to have more people, especially startups, getting a lot of funding, because the new digitization that we are seeing all around is actually fueled by newer players.
So how hopeful are you of flows? We've seen a pickup, but do you believe that that's likely to be sustainable?
See, I think we saw a huge amount of flows in FY20 and calendar year 20, where we saw 23 billion. And then last year, we had 16 billion flow out. And in the beginning of this year, you actually saw a flow out, but the last 2 months look very promising. And actually, the last May, which is currently on, has already shown 3.9 billion. So we are looking slightly better than rest of the world, but the global trends do overlay. So we will look slightly better, but we cannot duck the global trends. So right now, even though US has a major issue on deficit and markets may close, people have revised equity targets to 4,300. So similarly, India is looking much better than many of the countries.
Yes, that certainly seems to be the case at this point in time. But, you know, Mr. Ramann, let's address this issue of unlocking domestic pools of capital, and especially in the context of the startup economy. Again, it's not a new ask. It's been on the table for years now. In fact, just about a couple of days ago, the government issued on Friday. It was a furious Friday with many clarifications coming in from all quarters, including one on the controversial angel tax. But on balance, has enough really been done to create this domestic ecosystem of capital? And, you know, to Kaku's point, whether these 89 unicorns stay 89 in number or not, I think a lot will also depend on how sustainable their own business models are. You cannot just survive from one funding round to the next. But, you know, in terms of this finally unlocking this domestic pool of capital to service the Indian startup ecosystem, are we any closer?
So let me just thank CII for inviting me here today. Let me take that question from the perspective of what we've seen in the last about 6 years that SIDBI has run the Fund of Funds program on behalf of the Government of India. So this is 10,000 crores, of which 9,000 crores plus has been committed to over 110 AIFs, and they in turn have invested in about 950 startups. The AIFs themselves have brought in nearly 4 times the amount of capital that SIDBI has put into them. And the ask of SIDBI was twice the amount, so we've seen 4 times coming in. The interesting part is that we do not have a domination of foreign capital. So, you know, I'm not talking about today. Today things have certainly turned adverse, but what we have seen in the last 6 years is a very strong resurgence of domestic capital, and probably we've managed this in a more orderly manner. We had 2016 the fund of funds of DPIIT. We had in 2019 or 20 we had the SRI fund coming in, which was another 10,000 crores for MSMEs. So, we are talking about reasonably large pools of capital that have come in from the government of India, but actually catalyzed that much more from within the economy. Again, I'm not dismissing the contribution of foreign capital, but we've seen a resurgence of, or let me say, the first-time birth of 40% of those 110 AIFs are first-time fund managers. So, there is a maturity that I think we've seen within the economy. We've seen probably a lot of Indians who were overseas have now started coming back and finding this to be a more attractive market. So all in all, we need to put our hands together for the JAM, for the UPI, for all the, sort of important infrastructure rails that are in place.
Let me address something that Mr. Puri spoke of, and since we're talking about competitiveness of India's financial sector, how important is privatization and or consolidation going to be in order for us to be more competitive?
Well, yeah, it is important, and I think we are continuing to maintain the privatization momentum, and there will always be ebbs and flows for various reasons, and some of the processes involved are also quite time-consuming, and there are litigation challenges at every step by different stakeholders. But I think if we have to unlock the efficiency of assets, both monetization and privatization are critical.
Is it more pragmatic then to take that approach and say, look, let's unshackle the public sector, the PSBs, let's allow them to function in the way that, whether it's hiring and so on and so forth, the way that the private sector does. I mean, there have been many committee reports that have given recommendations to exactly that effect, and let's not overstate this need for consolidation and privatization.
Yeah, I mean, I think the reason we're talking about this less today, in a way, is simply because the rest of the banking system has grown to a point where the relative impact of the underperformance of the public sector banks is less of a drag on the financial system as a whole. So we've got a good outcome, which is just a function of that phenomena. And by the way, I'm glad we're there. I continue to be highly skeptical about so-called reform mechanisms within the public sector construct. I have been for 25 years. I have never believed it is possible in our system to reform a public sector enterprise. Privatization is the answer. There are political constraints on privatization, in which case the next smartest thing to do, which is what I think we're doing, is to reduce the relevance of the public sector. That may seem a little, I guess not very optimistic to some, but actually it is a very intelligent approach. It is the only approach that has actually been proven to work in India. And not just in India, by the way. Outside of Singapore and a couple of places where you happen to have philosopher kings running the government, there's pretty much nowhere where this has worked. So the good news is that the public sector banks today are able to do less harm to the financial system, even should they, for some reason, continue to be poorly managed. And I fear they will continue to be relatively poorly managed, despite, and this is not a reflection on the quality of management, this is entirely a reflection of the contradiction of forces and governance under which they have to labor, and we have not achieved any improvement in that in the last 25 years.
Gross FDI inflows into India are down by 16% in FY23. That's the first fall that we've seen in the past decade. Of course, the FY22 base was also significantly higher. But what's your view on this, especially in the context of the fact that we are likely to be beneficiaries of this global supply chain de-risking that's taking place and so on and so forth. And what more do you believe we need to do? I mean, most sectors have been opened up completely, automatic approval and so on and so forth. But what more do you believe we need to do to ensure that we continue to draw in the kind of FDI that we aspire?
Yeah, I mean, your numbers are right. For example, I think if I'm not mistaken, in the first 11 months of in the last financial year, we got about gross $66 billion compared to 84, which in the context of the rising interest rates and geopolitical uncertainties is not a bad performance. It's a pretty good performance. I mean, yes, you are right. We have opened up many sectors, but also, I mean, whether it is with respect to issues on the investor-state interaction and protection regimes, or in the stability of tax policies, or for that matter with respect to our last-mile connectivity and plug-and-play issues in the infrastructure on the ground. These are all the areas where we can still continue to make improvements that would bring these monies into India. I mean, but it's very promising that, for example, last month, I think, Wall Street Journal had a very big story on calling India the new factory floor of the world. And I think that's, and it is not just on the basis of one or two companies relocating to India or adding India to their investment bucket list, but definitely it is more than one or few companies. It is the beginning of a trend. And I think as companies come to terms with uncertainties in their own backyard, I think their ability to focus and concentrate on this supply chain diversification, including India in their list of countries, will only get better.
I know you've defended the imposition of the 20% TCS as part of the LRS chain, saying that it's not retrograde, it's not perverse. But for an end customer, sir, and I understand bringing credit cards into parity with debit cards and so on and so forth, which is what the regulator with the RBI also said. But at 20% TCS imposition, it impacts the common citizen. It impacts, you know, every transaction that I make, for instance. And I'm an honest taxpayer. I can claim at the end of the year. But at that point in time, it is a 20% hit.
First of all, they have exempted transactions up to 7 lakhs of rupees from this TCS. So bulk of the transactions made by most of us will not be covered under this levy. And there is also attempts to link the TCS with your tax deduction at source, such that if there are TCS payments being made by you, then it has to reflect in a lower tax deduction at source, such that it simply is a matter of making sure that you are not affected from a cash flow perspective. That is the second thing that is happening, and that will also provide a huge amount of relief for people who are concerned about this annoyance or irritation of seeing a TCS apart from your TDS, etc. And the third thing is you have to understand that there are data that are available with the government that do point out that this mechanism has been not just abused by a small set of people or who are evading taxes, but it is the volumes involved are fairly substantial. One point of view that is being made is that all that you needed to do was make it 1% or 5% so that you can track it, but there are people who are happy to stay out of the tax net. If it is 1% or 5%, that is still a price that is worth paying for them. So there has to be a deterrent effect as well, at the same time without inconveniencing, as you pointed out, those who are going about paying their taxes. And that is why I think the exemption was done, and B, the pass-through of TCS into the TDS deductions will also make sure that the ordinary taxpayers do not see any impact as far as they are concerned.
Well, you know, I won't get further into this conversation because it'll require a lot more time. But Leo Puri, you know, I think we're pretty much at the end of our session and at the end of our time. So I want to get wrap-up comments from each one of you. And I think we've touched on a whole host of issues on the opportunities, but more importantly on what the road ahead should focus on in terms of priorities. At this point in time, what is the next big disruption that you see for the financial sector? You know, we've seen what UPI has done in terms of digital payments. payments. We have now seen what the account aggregators potentially likely to open up by way of an opportunity, not for the incumbents, but for the company outside of the incumbents. What's the next big disruption that you believe we need to be prepared for, or that you foresee for the financial space?
The one that I would hope for is the one I referred to earlier, which is where instead of banks holding only the best assets, where the bulk of their balance sheets are essentially buy and hold of AAA rated companies, we actually have risk transfer, mechanisms for risk transfer developing, whereby, as Mr. Ramann said, you've actually got people who actually need access to bank capital, not getting crowded out. And eventually, by the way, even they can be securitized, pooled, and transferred, which is a hallmark of a developed system. So it's financial deepening. The big disruption, positive disruption that needs to occur in India still is financial deepening. And I think we can get there through the development of capital markets. And part of that is technology enabled, of course. Part of that is our confidence to integrate somewhat, whether GIFT City indirectly or more directly, with global markets, gain the confidence to do that. And I can't resist saying on that last point on TCS, sometimes one of the occupational hazards of being a public servant is you have to defend policies that you may not want to.
Well, Mr. Ramann?
So I'll clearly say that on the heels of what's happening in the country as we speak is the formalization of the informal entities. We're talking 7 crore informal entities across the country. And the definition by my dictionary is GST versus non-GST. Yeah. So, you have the GST guys and you have 7 crore non-GST guys. Now, how do we bring them in? They're all paying interest rates of 30% and above. So, do we look at what, actually it's not my original idea, but it's what the Standing Committee of Finance said, that let's look at a Vyapar credit card. We now have got credit on UPI. We can actually look at a credit card on UPI and make that working capital come into the hands of all these small 7 crore entities. Some of them are just needing a working capital of 2,000 rupees, which they then turn around every 5 days. So, there is a huge disruption waiting to happen. It's really about making the credit come to them at reasonable rates. I'm not saying they'll get 10%, but even 15% is good for them. So, get them to become productive. They will become, sort of suppliers to so many more people. The value add that they can bring in is huge.
CA, I'll give you the last word.
Thank you. I think more than innovations or disruptions, the one disruption that I'm still looking for is the behavioral disruption, willingness of large private sector entities, government departments, ministries, public sector enterprises to get into the culture and the habit of paying their MSME suppliers on time. That is the disruption that I'm waiting for.
And that message has been sent out many times over from the government to the private sector, and hopefully we will start to see that change. But thank you very much, CA. Thank you, Mr. Ramann, Kaku and Mr. Puri for joining us here this afternoon and giving us your insights as well as your take on what the potential disruptions could be, but more importantly, what the road ahead looks like.